Welcome, everyone. My guest today is Matthew VanFossen, CEO of Absolute Home Mortgage and CEO of Mortgage Automation Technologies. He's also a board member of the Community Home Lenders of America, or CHLA. We're going to talk about some of the pressing issues for lenders in this environment and the CHLA's Consumer Mortgage Bill of Rights. First, here's a word from our sponsor. Hi, I'm Sarah Wheeler, Editor-in-Chief at HW Media, talking to Desmond Smith, Chief Growth Officer at UWM, about SafeCheck. Desmond, how does SafeCheck work?
Hey, Sarah, how are you? So I would say first, SafeCheck is allowing LOs to give their borrowers peace of mind. So I'd start there. Trigger leads have become a very large issue, not just in the mortgage space, but in any time someone's getting any type of credit. So we created SafeCheck to help prevent kind of that aggravation and nuance of receiving, tens, 20s, hundreds of calls that consumers receive. So what happens with SafeCheck is any LO who uses UWM, it's an exclusive product, SafeCheck is to UWM, they would be able to either pull a single or a tri-merge soft pull credit report. And while that credit report is being used to run AUS, they will have time to opt their consumer out of any solicitations, and then therefore they will not receive all of those annoying calls and annoying solicitations. And that is also a big benefit because the cost of the credit bureau is much cheaper by leveraging SafeCheck. So it really is a win for LOs, and it's obviously a win for consumers so they don't receive so many phone calls offering all different types of products and services.
I can see how that could be a game changer. Thanks, Desmond. And listeners, you can find out more at uwm.com. Matt, welcome to the podcast.
Thanks, Sarah.
Great to have you on here.
I'm excited to be here.
Yeah, the Community Home Lenders of America, it's been really active over the last several months. I mean, you guys are always advocating, but you have done a lot of things lately, and I would love to talk to you specifically about the Consumer Mortgage Bill of Rights. So hope you're up for that.
Yeah, absolutely. I work very closely with Taylor and Liz on the project. It was a lot of fun, and it kind of assembles a lot of the different things that we've been working on over the past 2 or 3 years into a universal document for consumers.
So as you note in the press release when you were talking about it, the mortgage banking industry is already really regulated. I mean, it's coming from a lot of different agencies, and, there's just a lot of things they already have to navigate. In your opinion, why do we need even more regulation?
Well, it's not necessarily about more regulation. It's more about that there's certain loopholes in consumer regulation right now that I think that over the past decade, we've seen a concentrated effort for consumer protections. With the implementation of Dodd-Frank and the SAFE Act, we saw MLO licensing, we saw the HMDA revisions, we saw TRID get implemented, right? And it was all around the same thing: clarity to consumers, making sure they're not being misled. A lot of the things that we learned in the financial market collapse post-2008 were implemented. But there's some leftover trailing issues that really need to be identified with more modern regulation. And that's really what this Consumer Bill of Rights identifies as saying, well, it's not us asking for more regulation. It's asking the regulators to go look at certain provisions or loopholes that still exist. And I can mention a couple of them if you want to go into some of the details of it. There's a couple that are identified in it that come off the top of my head.
Well, I would say the one that almost everyone could agree on is the very first one, which has to do with trigger leads. So tell us a little bit about that one.
Yeah, so trigger leads has been a big part of our Bill of Rights. It's our first item we tackled because, myself being a loan originator for 20 years, when we get a consumer come in for a pre-qualification for a mortgage, one of the first things you're doing is asking to pull their credit, right? That's going to give you that deep dive. And one of the concerns is, we encourage through TRID, and even the regulation through TRID encourages consumers to shop for a mortgage, right? They encourage them to go to multiple locations. But when a consumer's mortgage or a credit is being pulled, what's going on is that data is being resold. Right, that data is being resold from the credit bureaus and turns into a trigger lead, and the practices have now become borderline abusive, where a consumer, after getting their credit pull, is sometimes getting in excess of 50, 60, 100 phone calls from third parties And, when we've monitored these phone calls, some of the information that's being relayed to them is misleading and concerning. Some of them are bad actors. They're making it seem like it's their lender calling them back. Hey, just giving you a call back, talk about your loan terms and fees, right? And trying to coerce them into a new application. And a lot of stuff that we've seen could be misleading or even predatory, right? Some bait and switch tactics to get them in and get them moved over to a different lender. So we're looking for better opt-out provisions, and more or less, instead of a opt-out beforehand, a general opt-out with then a opt-in provision. So allowing consumers to opt in to be solicited rather than to have to opt out to not be solicited. And we think that that would remove a lot of confusion in the initial phases of applying for a mortgage.
Yeah, I think that that's just such a bad experience for the consumer. They go shopping and then they're just inundated for the next 3 days in a way that makes them feel badly towards all parties, I think.
Yeah. I think when we were talking to some regulators about that, that was the statement that we encouraged. We said, we encourage you to blindly apply for a mortgage and watch what happens to your cell phone. And you'll understand it.
I think your number 3 here is one that, again, I've heard a lot about, and that's on the right to affordable credit report pricing. I feel like I was just at an industry event a couple weeks ago and really heard from lenders. They talked about the costs associated with going from 3 credit reports to 2, and just there was a lot of things about that decision. And, when you look at FICO and some of the pricing that happened over the last year, I mean, this is a real touchy point for people in mortgage, I think. So explain to me what, CHLA there, what your position is there.
So there's a couple different prongs to it. So let's take the FICO price increase first, and then we'll talk a little bit about what's going on with buy merge, try merge, and Vantage, because there's actually 2 different policy issues rolled into one that is important that I get identified. No secret, rates went up over the past 18 months consecutively. Been a very difficult time for midsize, large scale mortgage lenders. Most mortgage lenders are looking ways to cut. The industry has gone through a substantial amount of layoffs. Not the best of times for the mortgage industry. And in the heat of all of this, while lenders were trying to normalize and right size their businesses, we saw in first quarter a FICO increase. They announced a FICO increase of 400%. Now, we understand that there's a changing market and that our vendors need to, adjust their price points. But one of the problems that we really saw with it was price parity, that there was 3 different tiers given to different types of lenders. And the 3 tiers were tier 1, tier 2, and tier 3. And tier 3 seemed to be, I think, somewhere around over 80%. Don't exactly quote me on that. Maybe even higher. I don't know the exact statistics, but the vast majority of lenders, large and mid scale, were bucketed into tier 3 pricing, which was the 400% FICO increase. And then there's a small subset of lenders that qualified for tier 2 and tier 1, which were less nominal increases. So I think that what CHL is really saying is, since these fees directly affect consumers, there should be price parity amongst all lenders when dealing with the credit bureaus, that, one lender, due to their size or relationships or whichever aspect that got them the tier 1 or tier 2, because that fee directly corresponds or translates down to a consumer fee, we think that those should be in full parity with one another, and there should not be tiered pricing. That's a reasonable request. And then where that translates down to is we're looking at FHFA right now and working with them on the buy merge, try merge, and then Vantage score. So our credit score modeling system is going to be exponentially changing over the next 2 to 3 years. And what they're going to be doing more or less is saying, hey, you don't need 3 credit scores to deliver a loan. We're going to reduce that down to a buy merge. So 2 credit scores merged together. That'll save some money versus a try merge might save, 20, 30% on a credit report. But we're going to factor in this whole other thing called Vantage score, which takes into different aspects of non-traditional trade lines, utilities, rent payments, stuff like that, and factors that into the borrower's credit score. Exactly these modelings, though, we're not sure of yet. We haven't seen the modeling as an industry, and that's what CHLA's big ask is right now. We're asking for delays of the process, of the implementation periods of the buy merge to the try merge to buy merge, and then buy merge to Vantage. There was a couple industry feedback windows that were opened up in May and June. We've asked for those to be extended. We've asked for the rollout plan to kind of not necessarily put the cart before the horse. We want to see what these reports look like. We want to run comparison data between our current pipelines and our current borrower sets and our past and new ones. We want to make sure that what's being said on paper with these buy merge and Vantage scores and the move over and the changing the backbone of our credit policy and underwriting and how borrowers are evaluated are actually going to do their intention, which is going to help consumers, especially low to moderate income and certain demographic groups and geographic areas, actually help them get into loans and make sure that it doesn't do the opposite of that and exclude them from home ownership. So we want more data.
More data. I think, one of the goals of CHLA is really making sure that there's like tiered regulatory oversight, tiered when Washington looks at different kinds of lenders and they're considering how big or what the capital requirements should be for all of that. And, the Basel III endgame, which we've been reporting on for the last, couple years, but in the last 2 weeks has taken on this twist, right? Where it was rumored and then sure enough, it calling for increased residential mortgage capital requirements for larger depository banks, which on the one hand, you could think, well, that's a win for your members, maybe, except that it does have some effect on the warehouse lines of credit, right? So where do you guys come down on that whole Basel III endgame?
So, it's a trickle down policy, right? It's difficult because whereas CHLA loops in, we represent independent mortgage bankers, right? We're not bound by Basel III because most of us are private capital, non-depository institutions. But it also just so happens that most of our warehouse lenders and our counterparty risk does get affected by Basel III. Right. So it's on our radar, right? We are looking at it. We have limited lobbying efforts inside of it, but we're communicating with FHFA on the issues. We're talking to the different regulatory bodies, and we are reminding our regulators that don't forget the trickle down economic policy of warehouse lending and making sure that independent mortgage bankers have access to these lines of credit, because it's the backbone of the mortgage industry, and independent mortgage bankers just so happen to service the large portion of low to moderate income and underserved borrowers that careful about these liquidity requirements. Because if these liquidity requirements are going to start pushing large scale depository institutions out of warehouse lending, then there's a counterparty risk that translates down actually to the consumer, and they have to be aware of that.
Well, and I think, we've seen other industry trade groups and other people in the industry say, what exactly are we what is that trying to solve? And is that even a problem, right? If we're looking at risk, yes, we had this banking crisis, but it was around some really specific kinds of banks with very specific models. And, some people are saying, is this cure worse than the disease? What are we trying to solve? And what are to your point, what are the effects that maybe they're not thinking about?
Yeah, and I think that's a great point. It's a big talking point in the industry right now. The regulator of 2006 and 2007 would dream of the market that we're in right now. I mean, let's face the facts. Mortgage defaults are at historic lows. People are paying their mortgages. The past 10 years post Dodd-Frank and the QM initiatives largely knocked out the subprime era. I mean, there's been a small subset of non-QM lending, but even the non-QM is very factually based on ability to repay. So, the problem of the predatory mortgage lending programs, the consumer risk, right? There's a high demand for housing. There's a low default rate. You would think that this is a dream housing market for a regulator, that what they've done in the past has actually worked. And that's what we're kind of saying is like, hey, let's not push more on this industry. Let's take a step back, because regardless of what's going on in the general economy, when we look at housing is remaining strong and borrower defaults are remaining low. So there's less systemic risk. Now, if you're talking about the systemic risk because we've seen some bank collapses, right? And there's a little bit of, concern about long-term mortgage-backed securities and how these have been taken down into MSR portfolios. Well, That's not because of liquidity as much as when you look at, we increased rates at a higher rate than we've ever seen before, right? So, nobody could have predicted or forecasted that when these banks were taking down these MSRs into their portfolios. These are long-term securitizations, right? They didn't think that they'd be devalued exponentially when rates went from 3.5% to 7% in a 14-month period. And now when the bank needs to create liquidity, what does a bank do? They have to liquidate their MSRs, right? It's one of the easiest ways because it's large-scale, long-term capital, liquidate the MSR. But the MSR is at a different evaluation now because the rates are different. Is that because we're producing bad mortgages? No. Right? Is there further risk inside of the independent mortgage banker market of the loans that are being manufactured? No, it's actually a direct correlation to the direction of rates and what we've done and what the Fed has done. So, that's what we're trying to say here is, hey, let's not look for an issue where there's not one. Yeah, we get the liquidity requirements. We get Basel III, but it doesn't mean that the loan manufacturing has changed. It doesn't mean that we have to create undue stress risk on the entire backbone of the system, which is warehousing. So we're very in tune and trying to pay attention to that warehousing issue.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to HousingWire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
I think that is one of the most interesting things and, could be overlooked because it's like, oh, we're not, this doesn't apply to the IMBs. It's like, oh, except it does, when it looks at
you already seen some warehouse lenders exit, right? There's a couple of companies that have already exited, the market this year because of it.
So, Matt, the next thing I wanted to ask you about, which is getting tons of buzz, at least everywhere I go, is, the issue of buybacks and the fact that it seems that Fannie and Freddie are being much more precise about those, are being much tougher on those. And every one that they do has a real economic effect, in this environment. So talk to me a little bit about that.
Yeah, so let's figure out, how do we get here first, right? How do we get to this current climate? The industry has been going through some rough times, as I said earlier, but it came off of the biggest peak that in my 20 years I've ever seen, at least. What goes up must come down, right? We saw record levels of originations from mid 2020 into early 2022 before the rate increases started. So when you go look at that, you have to expect that the trailing issues of 400 or 500% increases in origination is a pairing of 400 or 500% increases in post-closing QC processes, especially when you look at the rate of manufacturing and that a lot of these lenders, their backs are up against the wall in their underwriting department, right? The staff was getting burnt out. We saw a volume surge and a hiring surge that the industry has never seen. So, when we start looking at the downswing of that, one, they created a backlog at the GSEs, right? The GSEs have QC policy, right? They need to do their QC samplings. I'm sure that they didn't staff up the way the industry didn't staff up and created a backlog. And what that did was extend that QC process out. And a lot of times what's going on now is the GSEs are doing their QC sampling and we're 14, 18 months out from consummation. But that leads to a problem because previously when the GSEs would QC, right? Let's say they QC, they give you a buyback. Okay, and you have a decision to either dispute and go through the dispute channels with them, right? Or you can take the loan back, you can try to refinance it, or you can scratch and dent it, right? There's all these different paths or avenues. When we used to do that in 2017, 2016, 2018, there wasn't a vast difference in rates. Usually you're getting those QC reports 3 to 6 months out from the origination. Maybe you put the borrower into a 5.5% rate and you got to drop it to 5.25%, take a loss or par the deal out, refinance them, get it off their books, correct the issue that it was, right? Now the problem is you're 18 months out, but you're 18 months out and you're 3% in rates out. So you just can't refinance the borrower out of that issue, right? So you're seeing a higher dispute. You're seeing a higher volume QC, right? Higher dispute levels. And then when you take it out of the secondary market, and you try to scratch and dent this loan, right? If you can't refinance it because the rate's not there, you can't win a dispute resolution with the GSEs. You're taking that to the scratch and dent market. And you're seeing sometimes, 35%, 30% haircuts. You're selling it, 70 cents on the dollar at a time where, again, lenders are having, liquidity restraint requirements. So it's creating this little perfect storm, right? So we're asking for a lot of more robust QC. How do we fix this problem long term? How do we do better post-consummations through the AUS engines? How do we get better data, right? Is day one certainty, the digital mortgage initiatives, is this the solution to it if we can get more data-based mortgage packages? So we're really digging in with FHFA and trying to figure out, okay, what are some of the solutions here? One big solution is, hey, how about we indem rather than repurchase, right? Because a lot of times, Sarah, the crazy part about this is these are performing mortgages. They're mortgages that are not in default. They're fully performing. There may be a material error, let's say in the income calculation, let's say in the appraisal, right, of the property, that it may not, fit that GSE guideline perfectly, but it's still a paying mortgage, right? It's still an on-time, fully consummated mortgage with a borrower that, is in that house, and it's a good loan. So, we've asked them to look at, FHA's policies a little bit and look at how the indemnification processes work and being able to structure that. That would be a really easy fix to the problem, we believe.
Interesting. So Dave Stevens wrote an op-ed for us this week, and it's an opinion piece, right? And he said, he feels like the GSEs are targeting IMBs on buybacks, which is ironic. In his, what he said is like, here IMBs are carrying the weight of the mortgage market on their backs right now. It's not depository banks who've pulled way back. So you want IMBs to, this is how mortgages are getting done, right? And at the same time, they've also helped Fannie and Freddie have, this is Dave's opinion, have amazing profits at a time when they themselves are really struggling, the IMBs. So I think in his view, it's like it's even beyond just like, you made this decision, or because what Fannie and Freddie have said are like, hey, nothing has changed in our policy. We're doing everything exactly the way we did. But even if that's completely true, you're doing it in an environment that is very changed from anyone we've seen, to your point about, that 3-point spread and the fact that, mortgage rates are just completely crazy right now compared to in a short amount of time. So I'd love to know your opinion on that.
Sure. Well, one, I have a lot of respect for Dave Stevens. He's been very outspoken past couple of years since his residency at MBA. And I appreciate and, have the utmost respect for his taking the forefront of leading the charge for independent mortgage bankers. It's really impressive to see what he's done. But, the key word there is opinion. He's got an opinion. I have an opinion. CHLA has an opinion. And when you ask me what my opinion is, well, I like to interpret what I actually witness, right? What I see with my own eyes. And, from going into FHFA, from meeting with the director, right? From looking at their policy objectives, looking at the current administration, what's going on in general in Washington, I don't think that there's a target on IMB's backs. And I'm going to tell you why. Because we serve the underserved. When you go look at the data, the vast majority of LMI mortgages are created by IMBs, the vast majority of underserved areas. So I don't think that they're coming in and saying, hey, the IMBs are the real problem here. Let's make it go so all these consumers are going to banks. I don't think that's happening. But what I do think is happening is there's certain mandates that the GSEs, being under conservatorship, have to follow. And that's being pushed down from FHFA, which is being pushed down from administrative policy. And not only the current administration, but previous administrations too. Don't think that this issue is just on Sandra Thomas's desk. There is a carryover from Calabria and the Calabria FHFA administration, right, that put more capital liquidity requirements in place. So when you go look at this, the GSEs have these mandates. The mandates are that loans have to be delivered with certain guidelines. And I don't want to make it sound like I'm defending the GSEs here, but it's pretty obvious what's going on is that they're following their mandate. They're making sure that they have strength, that the GSEs are strong, that Fannie and Freddie can continue to serve, right? We saw LLPAs go into place. We saw all of this, but to say that there's a target on the back of IMBs, I don't agree with that. I just think that since IMBs have created such a large quantity of the mortgage originations in the marketplace, it just so happens that the GSEs are working more closely with us and we're under a little bit more scrutiny because we've taken such a large share of the market.
When you talked about looking forward and saying what is the solve for this going forward so we don't have the same problem, continuing. If the loans are performing, I'm not an originator, so I'm not in the weeds on this. But if you have a loan that's performing, isn't there maybe a different set of rules or more flexibility with that loan?
Well, that's what we're, talking about with the indemnification, right? Instead of taking a loan as a full buyback and unloading it for a 30% loss, maybe we can make an agreement where, it'll be a 5% haircut or an indemnification fee. And then if the loan goes into full default, at that point is what, guarantees the buyback to occur and you're taking that loan. So that's a very viable solution right there to fix this issue. But you still wind up with the seller service contract issue, right? When we sell a loan to a GSE, right, we're giving reps and warrants on the file, right, that say that this loan meets a subset of guidelines and it has been underwritten and credit certified in accordance with those guidelines. If it is found that that loan does not meet those guidelines, that is a contractual issue, right? Which is hard to argue. And one of the issues with these contractual issues when it relates to directly to the mortgage industry is a lot of mortgage industry stuff is a little gray and is a little bit opinion based, especially when you get into credit underwriting. Sometimes even within the same company, you'll see different underwriters take different opinions on side, and there's great debate over a guideline and how it's met. It's not black and white. There's a lot of gray. So that's what makes the conversation, extremely difficult and very complex, and why it's one of the largest debated topics right now, because it is affecting capital. It's putting financial strain. And, I would say the GSEs are between a rock and a hard place because they have to answer to their regulator. And they also have to, be able to make sure that seller servicers are still strong.
So walk me through, besides the things that we've already talked through, between here and the end of the year, what are CHLA priorities? What are their top priorities?
Yeah, so CHLA top priorities, we're taking up several initiatives that are really our core focus, right? So one is that FICO, right? FICO parity and price parity is big. Two, the extension with working with FHFA, trying to get an extension on these implementation periods for the Vantage and buy merge rollout. Three is those trigger leads, right? We definitely want to see those trigger leads go through. We're going to see what's going on with the ICE initiatives, right? As you said, there's a lot of current events with that, but I know CHLA was pretty involved in those as well. And then we're taking on a couple of different things that we're going to try to put back on the table, things like MLO compensation, right? We want to get that on the CFPB's radar. We were very close under Kraninger to getting it on the roadmap and getting it on to the agenda, if you will. But now with a leadership change, we're trying to get it back on there, but we're seeing what, the tolerance is for that. But, we've been working on this one initiative for several years that's really about the SAFE Act testing, right? That we said, hey, IMB loan officers are required to take that SAFE Act test. Right. And we agree with that. We think that it did a lot of cleanup in the industry, but the banks aren't. Bank employees are not. And where we're now bringing that back around is this whole other issue of dual compensation and it's becoming one of our primary initiatives right now. Last December, FHA released a mortgagee letter that said that dual compensation relating to real estate agents, where a real estate agent on an FHA loan with proper disclosure can receive compensation as the loan officer or real estate agent at the same time. So we looked at that and we said, okay, well, how does this carry over to this consumer bill of rights that we worked on, and where are the consumer loopholes in this? If it's now what was referred to as the proxy, right? Because it used to be, okay, FHA was thought that did not allow that. FHA then came and said, hey, look, we're just like the GSEs. GSEs allow it. We're going to allow it. But now it lifted this general proxy that kept a lot of lenders out of it. So now when you look at this, we're tying it to our other issues. We're tying it to MLO comp. We're tying it to the SAFE Act licensing issue, because what we don't want to see is a couple of things. One, we don't believe that a seller, a listing agent, right, should be able to represent the buyer's mortgage transaction. So if you're a listing agent, right, and you have a house for sale, and your objective is to represent the seller of the house, we don't think you should be preview to the buyer's mortgage information. You shouldn't be able to see the max qualifying parameters, the maximum ability they can afford, the cash in the bank, the information that the loan officer is privy to. There's no regulatory stipulation right now that would prevent a listing agent from being able to represent a buyer's mortgage. And then where that kind of ties in, okay, to dual comp, right, and getting paid on both sides of the transaction, is there's also no regulatory requirement if a real estate agent went and worked for a bank that there's a barrier of entry. So what we're trying to say is, if you're going to leverage dual comp, if you're going to be on both sides of a transaction, you're going to be on the real estate side and the mortgage side, you need to pass that SAFE Act test, right? And these are two stipulations we put in for consumer protections, right? And we think that's fair, that the seller, the listing agent, shouldn't be privy to max affordability of a buyer, and that if that listing agent or that buyer's agent is going to represent somebody for the mortgage, that there should be a minimum barrier of entry other than internal testing and education requirements at a bank, that they should be at least have to pass the SAFE Act tests, and they shouldn't be under the federal registrant exemption provision of registered MLOs in the industry, that a realtor can go work for a bank and then all of a sudden start doing mortgages.
Thanks for walking us through that. So you have on this homeowner's bill of rights, you really have a lot of different, you're asking the FTC for some things, the CFPB, FHA, just different things. From your perspective, what are the chances of these things being adopted? What do you think your chances are of seeing progress on these this year?
Well, it's interesting, right? I think the answer to that is advocacy in action. Does it work? Does it not work? And this is not something that's like a light switch, right? You can see a direct result in it. It's much different than that. This is the long game, if you will, right? And the DTI-based LLPA issue that was in the first half of this year is a perfect example of that, right? We went through the second home DTI adjustments the year before. We got a temporary stay on it. It was one of Sandra Thompson's first actions that we worked with her on at FHFA. And now, in light of the DTI-based LLPAs, we went into FHFA. And we weren't the only ones. MBA worked on this as well. Other industry trade groups worked on this. I'm not saying we're taking credit for it at CHLA, but we met with FHFA on it. And, we brought through the light of, hey, look what's going on at the CFPB. Look at what TRID calls for in this. Do you think it would be good for a consumer that has a borderline DTI to potentially have their rate fluctuate 3 or 4 times, potentially more throughout the transaction, which would then cause, numerous redisclosures for us to be, in compliance with TRID? We think that's misleading. We think it would confuse consumers. We don't think it's good, right? And we really took the charge on those DTI-based LLPA issues, and we got it done. Right. And I'm not saying we're taking credit for it. We were part of the overall machine, but that's how this advocacy in action works. So what you have to do is you have to, one, lay out what your stance is, right? Create your policy initiatives, get your constituents to agree, articulate them properly, and then show how they all roll together. And if you visit the CHLA website, I think you can really see that. You can see that over the past 2 or 3 years, we have been, every other week fighting for a different issue, but they all tie together. And you have to make sure that you're in the regulators' offices. We have regular meetings with CFPB. We have regular meetings with with FHFA, right? We have regular meetings with FHA, and we're talking to the policy administrators. And what we're generally doing is raising awareness, right? We're not going to get everything done. It's impossible. That's not how Washington works. If you ask for 10 things and you get one thing, that's great, right? That's great because that means that they're listening. And that's what you have to do is you have to educate, be in their face, showing them what's going on and showing them that the policies that are being discussed and the policies that are being acted on, how does that actually relate to consumers? And how can that actually have unintended consequences? And as long as we stay on that path, then I think we're going to accomplish a lot of things. I mean, we're not going to get everything because you can't, but generating that awareness is key.
I think those are really good points. I think the LLPA changes made their way into the popular mainstream media in a way that fired up. I feel like, maybe those in Washington were feeling the heat from a lot of different perspectives, but it was also a great example of different industry groups working together. So I don't want to take anything away from that because I do think that's a great example going forward of like, hey, this worked. I just also think in that particular case, you had just a wide swath of the public that was, kind of throwing a fit too.
Well, that's what you got to look at, right? Is what happens when you start asking for everything, right? Because if the mainstream media, in essence, gets a hold of something, right, there can be, a little bit of skewed stuff. And this goes back to the mandates, FHFA, the liquidity requirements. It goes back to everything. They needed these LLPAs, right? And there were certain initiatives that were being going on where they could figure it out, okay, how to do this, how to actually get better liquidity, how to implement these LLPAs, how to make sure that it wasn't impacting underserved borrowers exponentially more than, other borrower subsets. And, certain groups went for an all-out elimination of all LLPAs, right? And CHLA, I think, kind of said, okay, that's not reasonable. That's not going to happen, right? That's a fairy tale. We understand they have to do something. So where can we get a win? And we really stayed true. If you go back and you look over the past 6 months, that when it hit the mainstream media and everybody was calling for the total wipeout of LLPAs across the board, we said, hey, we really think that the DTI one is the one we can get a win on because that's the one that causes the most amount of operational concerns at a lender, at an IMB, because you're talking about the lock desk, the disclosure desk, the underwriting department, retraining, policy, procedure, right? All of that was factored into that DTI-based LLPA, and we really stayed true on let's keep asking for just this one carve-out because that's the one we think we can get the win on.
Matt, thank you so much for being on. Very informative, and we will keep watching to see which of these initiatives go through, and just thanks for being on.
Thanks, Sarah. It's great.